Once we've completed the financial statements, one of the things we want to be able to do is look at them and gather some information from them that may not be so obvious by looking at the numbers. Financial statement analysis is a tool that's often used in order to do exactly this. And one of the things that is important in this is to do some sort of financial ratio analysis. And really, this is a technique for comparing a relationship between, say, two or more financial bits of data from the company's financial statements. It's mainly used as a way of making fair comparisons across time and between different companies or between different organizations. So we really need to be able to kind of assess how is the business doing relative to last year or relative to somebody else. So the current ratio is a common tool that's used to evaluate a company's ability to pay its bills. Okay, and what it does is it takes the current assets that we just saw in the previous video and the current liabilities, and it compares the two. And what we're really asking here is saying, can we pay our bills? Because current assets are assets that can be converted into cash within, let's say, 1 year. And current liabilities are liabilities that are going to come up for payment within 1 year. So we really need to be able to cover the payments. And the current assets can do that if they're greater than the current liabilities. So what we're trying to do with the current ratio is get an idea for, can we pay our bills? We want our current assets to be higher than our current liabilities, because that would indicate that, yeah, we can do that. If our current liabilities are much greater than our current assets, that's going to send off some bells to us to say, hey, can we pay our bills? Is this going to lead to financial trouble for the business? Some basic warnings or concerns with the current ratio is that they really shouldn't be used in isolation as a measure of liquidity. We really need to think about, are there other factors that come into play besides current assets, current liabilities? They certainly vary from industry to industry. Some industries are much more in need of quick cash, and the flow through of money is much greater. Other industries not so much. And they may be tracked over time really to spot some sort of trend. We want to be able to say, has the current ratio changed over time, and has it changed for the better or changed for worse? And certainly there's all kinds of industry norms out there what the current ratio should be, and we want to be within that industry norm. The current ratio is often criticized for not being strict enough. The quick ratio is a stricter form of the current ratio, and effectively what it does is it looks at only assets, current assets, that are really, really, really easily converted to cash. In other words, it throws out things like inventory. Inventory may not sell, right? So if we think about what exactly are the things that are as close to cash as we can get, usually is cash, cash equivalents, marketable securities, or accounts receivable. These things usually turn over within 1 year. And then we compare that against the current liabilities. So again, it's a stricter measure of the current ratio. When we have our financial statements, one of the things that we often want to do is be able to kind of judge the health of the business. And, it's like taking the pulse on someone. So one of the useful tools, one of the most useful tools for doing this is something called the debt to equity ratio. And the name indicates exactly what we need to do there. What we're doing is looking at the total owed, what's owed by the business. And we know that what's owed by the business is either owed to non-owners, we call it debt, and what's owed to owners, we call that equity. And what we're trying to do is to measure how much of the business's owings are owed to outsiders versus insiders. So it's the degree to which the company is financing its operations through debt versus wholly owned funds. So it reflects the ability really of the shareholders' equity to cover the outstanding debts of the business. So what we're looking for is a nice, healthy debt to equity ratio. In other words, the owners want to have a good bit of interest in the company as well. So the higher equity relative to debt would indicate a stronger business and a business that has the ability to pay its bills and cover its debts.